technologically we can get there tomorrow, right? It's more about regulatory clarity. What is the legal and client relationship? How do you think about which assets, real world assets that we talk about bringing on into crypto and making it programmable? So what I'd say is that what we're doing now, given that the future of trading is pretty much borderless, it's around the clock, it's 24/7, and crypto rails has allowed that, is that this lays the groundwork not just for myself but the other exchanges worldwide to be able to provide equities and digitize them to become more programmable. So tokenization of equities is a term you hear a lot about. I think when you think about global liquidity pools and global access to capital, and then demand for these assets, no matter where they might be in the US or Europe, I actually think this lays a great groundwork for companies to start thinking about how they should list, who they should work with, and where those global liquidity pools come from. I think a lot of people think of crypto and traditional equities and traditional finance differently, and we don't, which is our core customer base is professional traders, and they exist all over the world very similarly in the way in which they think, eat, and trade. And so Coinbase, we think, and Robinhood in terms of prosumers and people getting onboarded into crypto. And then you have other companies similar to Interactive Brokers that focus on professional trading and day trading. So for us, our goal has always been to be a leader in crypto assets, but also be a leader in the way in which our professional trading and customers and clients want to trade, may that be long-term or short-term. And so this is a part of the path for us to continue to do that. In addition, we went to an agreement to acquire a company called NinjaTrader that focuses on professional trading for retail derivatives. Mm-hmm. So what you see us doing is just go across a wider range of asset classes, including equities and commodities.
Both the dollar declined and U.S. Treasury yields rose. And what that suggests is that investors are beginning to shun dollar-based assets, and that calling into question the safety of what is the bedrock of the global financial system, namely U.S. Treasuries.
So there are two separate questions being discussed around American exceptionalism. The first, whether the outside U.S. returns an overweighting of U.S. and underweighting of the globe by both U.S. and foreign investors, whether that continues. And second, whether there are legitimate questions about the dollar's global reserve status. Barclays writing a very long piece up and down both hands this morning, saying it's hard to think that there will be a liquid and deep alternative to U.S. credit to diversify away from more structurally. Still, even small such moves in reserves over a short period of time can have abnormal price effects. So while stocks recovered this morning, the large part of last week's decline in bonds and the dollar, well, they remain, as do these questions about whether this is a temporary blip, which we have seen before in COVID and, again, the great financial crisis, or the start of something more lasting.
I think they're tremendously damaging. They're at levels that are almost prohibitive of trade. And I think it would be beneficial for both sides. I will say in the case of China, and I've made this clear during my own visits there, we have legitimate grievances with some of the policies that China has followed to massively subsidize its export sector, its manufacturing sector, particularly advanced manufacturing, and its overall macroeconomic strategy, which places unusually low emphasis on consumer spending as a source of demand and really relies on flooding the world with Chinese goods. I think this is legitimately damaging to the U.S. economy, and something that we were discussing, and I think there should be dialogue and an attempt by the Trump administration to pursue this issue. Working together with our allies, I think, would have been a desirable approach. It's one that we were committed to. But now the Trump administration is really engaged in some very antagonistic initiatives relative to our closest allies, and that looks like a less promising approach than I would have hoped.
Do you have a sense of who is dumping U.S. assets? Who's been dumping U.S. treasuries?
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up. We had three big auctions last week, and on the longer end auction, 10-year, 30-year, we saw increased foreign competition. So I actually think this is one of those occasional VAR shocks that you get in the trading community. I think a lot of people got very leveraged, maybe out over their skis, and then you combine that with some real money selling, and you get these moves.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereigns. And look, Anne-Marie, not you, but the nature of journalism is to create a headline that 10 days ago, when 10-year yields hit 390, said, well, Secretary Bessent got what he wanted. He got 10-year yields down, but it's the wrong reason. Now, I forget what they hit on Friday, maybe 440 something.
We saw a 50 basis move last week in 10-year yield at the same time that the dollar was weakening nearly 3%. How do you simultaneously look at that situation? It feels like investors are dumping U.S. assets.
Well, look, I've learned that not to look at what happens over a week. Right? Like, I, for better or worse, have lived through a lot of these things, and in trading, in one's personal trading history, it's the scar tissue that sticks with you the most. I can tell you exactly where I was standing in 1998 when the long-term capital, the debacle happened. That had nothing to do with anything other than a bunch of geniuses up in Greenwich who had too much leverage.
So you're not concerned at this moment about the U.S. dollar or the U.S. Treasury losing safe haven asset?
No,
we're still a global reserve currency.
We are still a global reserve currency. That we have a strong dollar policy. The dollar can go up and down. If you go and look back at President Trump's first term, I don't remember the exact number, but the dollar in 2017 went down, I can't remember, 7, 8, 9%, and then once the tax bill was done, took off for the remainder of his term.
Welcome to the Crypto Teacher, and you know I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And make sure you're joining the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. And also, guys, make sure you go like and follow the TikTok. More videos to come. And we have Kraken's co-CEO says that tokenization of stocks, ETFs, and bonds, the technology is there and ready now. Only thing they need is regulation. And we have Kraken pushing adoption for retail and institutions, bridging traditional finance to DeFi. And we know DeFi is definitely the new banking. And remember, the Crypto Teacher told you. And we have Janet Yellen on the dollar, declining and yields rising, meaning that trillions are running away from dollar assets over to other countries. And she also talks about tariffs and admitted that China flooding the world with cheap goods is the problem. Don't forget, she was over there saying that they wanted to stop the cheap goods. Remember, guys, this is a plan that moves in phases. Now China is allowing those goods to stay on the mainland and then also flooding the emerging markets, but those goods are no longer coming to the U.S. And remember, the Crypto Teacher told you. Now we have Scott Bessent tried to deny dumping of U.S. treasuries, and don't forget, guys, he's a George Soros guy. And we see Argentina allowing stable coins to run wild, and we see the peso sinking. And that's exactly what's going to happen as soon as the U.S. gets stablecoin regulation. We're going to see the dollar sink. But remember, we're going to a level playing field. And remember, the Crypto Teacher told you. And we have Trump says he's going to be talking more about tariffs next week. And we know they're doing nothing but pumping and dumping the markets. And we have the Fed will be forced to cut while we still have inflation. And like I told you, time and time again, that's what was going to happen. The labor market is going to get weak. We're just going to get more and more layoffs But of course, the corporations already have the solution, and that's the machines. And remember, the crypto teacher told you. And we have the lower consumer is taking a beating. But you have a lot of nationalities, a lot of countries that know how to manage their money. We know the U.S., we're spoiled. We just keep spending. And of course, in the U.S., they're still distracted on things that don't matter. And by the time they wake up, the fourth industrial revolution will already be here. The robots, algorithms, and drones take the economy over, pay each other with crypto, and the sheep go inside the metaverse. Remember, the U.S. is the last free nation. And remember, the crypto teacher told you. And we have the dollar and the bonds very volatile, which we know is planned. Trillions were moved out of the U.S. assets because why? It's time to build. It's time to move this digital economy on. All they need is that crisis. And no one is talking about Japan. And they eventually have to go into a rate hiking cycle, which will force them to sell U.S. treasuries. But of course, the Fed has a controlled solution. They'll come in last minute with these stable coins. And remember, the crypto teacher told you, because he knows when it comes to the NWO, it's all planned out. You have a wonderful day.
You've come here at a time when the IMF has just announced this $20 billion agreement with Argentina, but we haven't seen a Treasury Secretary come to Argentina since Trump's first administration, and that was for a G20. So why the emphasis from the Trump administration on Argentina?
Well, Anne-Marie, a couple of reasons. The reason for being here today is today's a fulcrum day. So the Milei administration has done 3 adjustments, and this marks the beginning of the third one. So they did a large fiscal adjustment, a large monetary adjustment, and they announced on Friday a large currency adjustment. IMF has allocated $20 billion to them. The World Bank has allocated $12 billion, and I wanted to come here today to show support for President Milei and his commitment to what I think is historic in terms of bringing Argentina back from the precipice.
Tariffs will be in place in the not distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future.
What rate the semiconductor tariff?
I'm going to be announcing it over the next week.
President Trump speaking from Air Force One on Sunday, pledging U.S. tariffs will be imposed on phones, computers, and consumer electronics, despite a temporary exemption announced on Friday.
Steve, I'm curious, as you kind of square the inflation expectations with the expectations for a rising unemployment rate, is there a level there that the Fed starts to look at and say, oh, maybe it is time to cut? And how do they do that if inflation expectations are also rising?
Yeah, you just really crystallized the Fed's dilemma right here. I don't think the Fed would act on unemployment expectations. I think the Fed would act on unemployment. So I think they'll watch this. They'll watch the idea that that this is an indication, perhaps, that unemployment could rise. This could reflect just a general decline in sentiment, or it could actually reflect people's experience in the job market finding, or in this case, not finding jobs. So we just want to watch that. It's something to be careful about. Consumer sentiment is way down. It's cratered. But as you may know, we reported this morning the CNBC NRF Retail Monitor came back modestly from 2 months of decline. So remember, there's how people feel and what they do. And sometimes those two can be disconnected. Let's hope that's the case.
Covering a lot of, as clients, corporate CEOs of public and private companies, and they're absolutely seeing the low-end consumer fall off. And in addition to seeing the low-end consumer fall off, there's actually a tier or striation within that. So we've talked over the last number of years about sort of the haves and have-nots as the wealthier get wealthier because of low cost of leverage and exposure to markets, and the sort of socioeconomic levels get more and more stressed. What they're now seeing is even within the lower socioeconomic level is a difference between, for example, Hispanics and how they are spending versus other populations. And so there's definitely stress in that market.
A lot of investors were very optimistic about the United States going into this year. A lot of people had very, very elevated U.S. equity exposure in their international portfolios, happy with owning U.S. treasuries that had higher yields than most other bonds, right? And now we're suddenly facing just an accumulation of shocks, trade shocks, shocks to foreign policy that people didn't expect. And people are getting very uncomfortable having these very big U.S. exposures in their European portfolios, Canadian portfolios, Australian portfolios. I could go on. And we saw it in the price action last week. Very, very dramatic. And it's continuing this week, right, with some of the biggest dollar moves we've seen for decades as these asset allocation shifts get in motion. People reducing U.S. exposure. And we don't have to talk about, is this the reserve currency status that is in question, but people just have too much exposure. We've been used to talking about U.S. exceptionalism, right? And certainly from a cyclical perspective, we have a lot weaker growth outlook. That's one part of it. But also structurally, there are some question marks about how safe U.S. assets are, and those two things together is a problem.
So how about this? How about if I ask you whether or not you are seeing evidence of this? When you speak to your clients, you talk to a lot of real money managers, asset managers, not just hedge funds, but mutual fund managers, pension fund investors. What are they saying? Is this something where you are hearing conversations about this as opposed to just saying, I think it's this?
Yeah, so we speak to chief investment officers around the world all the time, and I think it's very clear that they're in the middle of an asset allocation shift. This is not like a hedge fund where it changes their decision from one day to the other and positions change very quickly. This is something that's going to go on for multiple months. They have big portfolios. They have investment committees that need to be consulted, right? But it's a shift that is in motion. We can also see it in our data. Like, we spend a lot of time tracking flow data. Over the last couple of weeks, big shift in terms of the attractiveness of European bonds versus U.S. bonds, something that's very rare. Normally they move together, but not in the last couple of weeks.
Let's get a little granular, because the move in dollar yen, last August, that triggered that whole sell-off in the equities market on August 5th. Very quietly, dollar yen's 143. I'm sure there are light bulbs and flashing red right now. Thoughts on the weakness in the dollar against the yen?
So last night we had some headlines that came across that said Scott Bessent was going to talk with Japanese counterparts about dollar policy, right? So a part of the uncertainty around the dollar has to do with dollar policy. We've been used to, for many decades, that we had some kind of strong dollar policy. And with this administration, we don't know exactly what the dollar policy is yet, but there's a lot of concerns that it could be a weaker dollar policy. Doing accords with Japan and around the yen would be something that structures an orderly decline of the dollar against the yen, and that's part of the thing. We can see it in the price action right last night.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
Like what you see in China and their social credit scoring systems, right? if we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
Bitcoin is an international asset. And also, I do believe the role of crypto is it's digitizing gold.
I actually believe this technology is going to be very important. Look at it. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Chinese bank ICBC has been hit by a ransomware attack, and the U.S. Treasury market, as a result of that, has been disrupted. This, according to the Financial Times. We're getting it more right now with Bloomberg's Shonali Bassick. Shonali, what do we know?
Listen, we have the Financial Times now reporting that ICBC, one of China's largest banks here, was hit with a ransomware attack. And remember, they're a very significant intermediary in the Treasury market. The SIFMA has told its members that this has been part of the reason here that the system is kind of clogged up, if you will, during that auction that we saw a little bit before. The attack had prevented ICBC, according to the Financial Times, from settling Treasury trades on behalf of other market participants. A large executive at a major bank also telling the paper that such a large party on the fixed income clearing corp creates major concerns, potentially impacting the liquidity of Treasury markets.
Now, it was not just a poor auction. It was absolutely lousy, and when the dealers have to step in to save a treasury auction, that's a rare occurrence. And
Cryptoteacher and the New World Order book, plus the 3 Kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Seaver, the biotech stocks. And while everybody's at home wishing, they were still getting that free money. What are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tanya save the village. Part 2. King Joshua and Grandma Tanya save New York. COVID 33. Part 3. King Joshua and Grandma Tanya goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.